Good morning and welcome this morning to Protective Strategies, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined today in the chat by my good friend James Boyd, also an education coach and a phenomenal instructor in his own right, 20-plus year veteran of the financial market. He's going to be there to help answer your specific questions about this discussion today. For those of you that are here with us live today, thank you for joining us. For those of you that came to this class from one of the live events that I've taught recently, welcome. Thank you for joining me, and thank you for following along. I appreciate you being here. And if you're watching the recorded version, thanks to you as well. We're going to talk a little bit today about some protective positions that we've put on that maybe need a little bit of adjustment. Oftentimes we'll do this just to make sure that we're keeping those protective positions and protective strategies where they ought perhaps to be prudently, number one. And number two, I wanted to talk a little bit about a circumstance that came as a function of a question from one of you, the viewers. And that is, what if I happen to have a short position in a stock, either inadvertently or advertently, and the stock is moving down, but I want to protect that short position against, say, for instance, a short squeeze or a quick abrupt move to the upside. So we'll talk a little bit today about the idea of a short caller, and we'll see how that strategy works as well. So as we jump into this discussion today, keep those things in mind, and we will see where we are headed. A couple of quick housekeeping items, though. Remember, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation or advice or an endorsement of any particular security or strategy or chart pattern. Remember that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks. Standardize options before considering any option strategy. Multiple leg option strategies will involve multiple commissions or transaction costs. Also, remember that spread trading must be done in a margin account. Be aware of those things. We're going to use technical analysis in this discussion. Technical analysis is not the only way to look at the market. Probability analysis, fundamental analysis, and others are available as well. All are theoretical. None of those give us a guarantee about what the market is going to do or what's going to happen next. But because of that nature and that theoretical, perhaps, perspective, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version. I have a demonstration account that looks like a live version. I guarantee you it is not. But remember that paperMoney is not a guarantee of future results. It's a great learning environment. It's a great playground and sandbox to work in. But it doesn't do a couple of things. One, it does not facilitate the early assignment of short options. And remember, if we are short an American style option anytime, that can be assigned to us up to expiration, regardless of where that option is, in the money, at the money, out of the money. It doesn't matter. There's that possibility that we could be assigned early. Now, the paperMoney platform doesn't allow for that. So you may see things happen that aren't consistent with a live trading account. Be aware of that as you move your practice from paperMoney to live trading. Remember that investing involves risk, including loss of principal, as we talk about stops in this discussion as well. Remember that stop orders and, in fact, stop limit orders, we can't guarantee the execution price, just the activation price. And in the event of a stop limit order, there's no guarantee that the order will get filled in any event. So we'll jump into this discussion here really quickly with a quick reminder, speaking of live events, and thank you for coming to see me in Nashville. We just got done last weekend with our advanced options webcast or workshop in Nashville at the Gaylord Opryland, which is a beautiful property. Next, we're going to be in Miami for a market drive event, which is a one-day event, top-down approach at the JW Marriott Turnberry on November 23rd. And then you can join us in Orlando for a two-day technical analysis and option strategies workshop, and in Houston for, again, the two-day technical analysis and option strategies workshop. All of those are at no cost to you. We feed you lunch, we feed you breakfast. Great opportunity to come and mix and mingle and to learn. So hope that you will join us for one of these opportunities if you are in the area, or you can you can travel to meet us at those locations. So we'll talk a little bit about this today, protective strategies, protective strategy applications. We'll look at examples on the platform. So what I'm going to do right now is I'm going to pop over to the thinkorswim desktop software platform. Let's take a little bit of a quick look at what's going on in the market right now. And we'll see where that puts us in terms of kind of the perspective of applying protective strategies. So taking a look at this upward movement that the market made. Yesterday, I talked about this in my trading flag patterns webcast, that this is kind of setting up for that idea of a flag pattern, right? A big and impulse move to the upside, a little bit of a pullback. So some traders who maybe got in on the bounce might be thinking at this point, oh, the market's made a pretty good move to the upside. Perhaps it's now time to put a little bit of a hedge, or what's sometimes referred to as a hedge wrapper, sometimes referred to as a collar, sometimes referred to as a risk reversal around long positions that have been making moves to the upside as they start to pull back a little bit, taking advantage of the fact that those calls have become relatively expensive because they've been going up, even though volatility has gone down a little bit. Let's take a look at what's going on in the NASDAQ here. Same kind of thing. Big, strong rally, 4 candles up. And then we see this little bit of a pullback. We see the RSI kind of rolling off a little bit as well. And in the Russell 2000, a big move to the upside, a little bit of a flag, and then a move to the upside now, kind of creating what Pat Mullally and I used to call a cobra pattern here on the Russell 2000, where we get at the top of this big run, a short-term, very cute, not cute, but a very acute symmetrical triangle. We called it a cobra pattern because it can strike one way or the other, right? It can go to the upside, and we can see that blow out as a flag pattern to the upside. That could also be a reversal and break down out of the bottom of that triangle as well. And it can strike just as hard in either direction. You can see the RSI kind of bleeding off there as well. So that's kind of the nature of the market at the moment. Running up, pausing a little bit, RSI, kind of that energy behind or the momentum behind the move, kind of at a pause point as well underneath that extreme level, that overbought range. On, hey, look at that. Carol's got a cobra right there in the emojis. So that's awesome. I like that. All right. So let's do this. Let's pop over. I'm just going to change my my group here to protective strategies. Let's pop over here to the monitor tab. Oh, before we do that, two things. One, this is a good reminder for me to remind you to click on that subscribe button down at the bottom of the page. And make sure that you're connected to the Trader Talks webcast channel so that you can see things like cute cobras. Exactly. Thank you, Carol. That made my day. That's perfect. All right. The second thing is I want to take a look at what the volatility is doing, what the VIX is doing. I mentioned it, but let's pop over to our VIX grid here really quickly and just kind of see what volatility is doing. Volatility now making that big move to the downside post-election, post kind of that news unknown. And we see that move to the downside. 30-period moving average of volatility kind of rolling lower. We see volatility maybe down in this 14 handle, about the 14.25 mark or so now at this point, kind of bleeding off. That would suggest that overall volatility has been higher, volatility is bleeding off. So that's kind of the scenario, right? With the market sitting at a point where it's pausing and volatility bleeding off, that we've seen a move to the downside the last 3 days, or kind of neutral candles, if you will, in the broad market, especially the SPX. We see the VIX bleeding off. That would be suggestive of the pause, perhaps more so than a reversal, but still maybe inciting some traders to want to perhaps put a little bit of protection on to take advantage of that circumstance where there is that little bit of a pause. We can see the VIX relative to the SPX, and we can see the VIX relative to its own volatility. So what this tells me, if the VIX is still going lower, but its volatility, the volatility of the VIX, the VVIX, is going up, that would suggest that there is some buying activity going on in put options primarily because they're used to hedge as this market maybe settles into that little bit of a pause. Some traders taking that opportunity to buy cheap protection. Buying cheap protection, meaning buying inexpensive out of the money put options, is kind of part of that caller strategy. And the fact that volatility is a little bit lower, but calls have been getting more expensive because the market's been moving up or individual stocks have been moving up, might suggest that there would be the opportunity to create a low cost or a no cost caller type of strategy on some of those positions. So let's see if that works out in this particular case. So I'm going to take a look over here on our monitor tab. We're going to go to a couple of these positions here that have been moving to the upside recently. In fact, let's take a look at one of those stocks, which is GM, which has been moving solidly to the upside. We've got long 100 shares of GM. We're going to go ahead and we'll bring up our single grid right here. And we'll take a look at GM. And GM's been moving higher. As a matter of fact, we looked at this a couple of weeks ago in our trading flag patterns class. And we were looking for GM to continue to move perhaps up to that target. Now, that being said, if we weren't looking at this or weren't trading this as a flag pattern and we were just long the stock and maybe we had been long the stock for some time, we're past the earnings announcement. The RSI is back up to a point at which it started to, we saw the market pull back a little bit or the stock pull back a little bit. And we're seeing maybe a little bit of price discovery going on with these candles. A little bit longer upper shadows on these candles and kind of going sideways a little bit. That might be the opportunity to put on one of those low-cost callers or perhaps no-cost callers in this particular case. So one of the things that, as we start to look at this, might be an incentive perhaps to put on that protection would be the fact that we're seeing that RSI kind of double topping here up in that extreme range, and we might see that little bit of a pause. So let's go to the trade tab. We know that we're long 100 shares of the stock. So we could put a stop on this, right? That would be fine. Putting a stop order on here to protect this position if the price of the stock were to move to the downside. But remember, the stop order has some limitations. Now, the pro side of the stop order is that it doesn't cost anything to put on. The perhaps pitfall or con side of the stop order is that it doesn't specifically determine at what price we might exit out of the position. We can specify an activation price, but not the execution price of a stop order. And we might run into a situation where the price of the stock moves down, triggers the order out, that order gets filled, we sell the shares, and then the price of the stock bounces back up and continues to move. That can be frustrating. So we're going to look at doing this, protecting this position, this long stock position, by creating, first of all, a protective put. So we're going to go to the trade tab and we're going to say, all right, fine, here we are on this protective or on the option chain, and we're going to take a look at the idea of putting on a protective put. Now, from a timing perspective, from a duration perspective, one of the things that we might want to think about is where are there events that might cause this price to move to the downside? We know that we've got a dividend X date here coming up in a little bit. That's in December. We know that we've got the next earnings announcement out towards the end of January. That might be a little bit too long to hold this protection. But if we were to maybe hold that protection through, for instance, the dividend, that might be something that we might think about in terms of that news flow and that event flow. That might be a reason to protect this position. So we're going to go back over here to the monitor tab, to the trade tab, and we're going to take a look at an option that expires, in fact, on the 6th of December on that dividend X date. Now, not that we would necessarily hold this position all the way out through the 6th, but that's 23 days to go until expiration. Now, here's one consideration when buying a protective put, and that consideration is this. Remember that time decay accelerates, right? Theta sensitivity, in other words, increases the closer we are to expiration, which means that this rate of time decay of extrinsic value accelerates as we get closer to expiration. So buying a put option, a protective put option, when that rate of time decay is relatively flat, goes along with the methodology of buying directional options. And selling an option when that rate of time decay starts to accelerate, like when this starts to fall off the edge of that cliff, becomes kind of the perspective of being the seller of an option. Now, when we're talking about a protective put or a caller spread, meaning buying a protective put and selling a covered call at the same time to provide that kind of risk reversal of that protection, that hedge wrapper, we kind of have to split the difference here, right? So we might end up in a situation where we're splitting the difference, where we're buying and selling kind of right on the cusp of that. So we get to take advantage of shorter time, more sensitive time decay in the call side, theoretically, but we're not losing too much in time decay on the put side, theoretically. Now, the other thing to think about, and I want to just kind of throw this idea out as a idea for thought. So just keep this in mind. And if any of you are mathematicians or statisticians, help me out with this, because this is my presumption. And again, I got to talk, my dad's a biostatistician, so I've got to talk to him about this. And I've seen this kind of in practical experience. But if we think about this, right, that if this is our time curve to expiration, right, that normalized logarithmic time curve of the at the money option, right, and it accelerates as it gets closer to expiration. The thing that I realize, I think, from a mathematical perspective, is that this curve is fractal, right? Have any of you ever seen those fractal photographs where they zoom in and in and in, and it's just that series of repeating patterns as you get tighter and tighter and tighter on the zoom, and tighter and tighter and tighter on the zoom. So it's the same fractal pattern, right? Mathematically, this theoretically should be fractal, so that in any particular time slice that we take, if we take that time slice, with the exception of expiration day, which becomes more binary, but if we were to take this particular time slice right here and we were to magnify that, right? If we were to blow that up, then that magnified time curve, that little slice of the time curve, is still going to look like this, right? It's still going to have that same kind of pattern, that kind of logarithmic approach, because of the way that this formula calculates time decay or uses theta. So if that makes sense, or did I might have just confused everybody here in this particular case by getting too deep into the math here behind this. But if that's the case, then we can create that caller pretty much at any point that we want to, based on the event, with the assumption of, yeah, we might, Jane, absolutely. Let's do that. No, we're not going to do that. My dad's also a topologist, by the way, so I have good conversations with him about that. But that being the case, we can create this caller at any particular point along that curve, up to and including perhaps, or up to maybe and excluding expiration day, and see the same kind of effect, right? So whether we buy this, or we create the caller way out in time, or we create the caller close to expiration, the relative rate of time decay stays just about the same compared to other portions. So let's kind of think that through. And what that means is we could really create this caller at any particular point. So I'm going to go to the December 6th expiration, 23 days to go until expiration, and we're going to open this up, and we're going to put this together. Okay? So we're going to create our caller on this GM position by, first of all, choosing, stock's currently trading at 58. So we're going to choose our out of the money put here. And one of the things to think about is, at what point do we want that protection to start kicking in? So one of the ways to do this is to go to the chart and look at where there might be a level of support. And in this particular case, I see a little bit of a resistance here, right about that 56 level or so, 55 half to 56. So right about that area. So what I'm going to do is I'm going to go to the trade tab once again, and I'm going to look right about the 56 strike. Okay. And that 56 strike, maybe even the 55 strike, depending on where the bid-ask spread is currently sitting. That's about the 30-cent delta or so, maybe a little bit less. I'm going to go to the 55 strike in this particular case, which means that the price of the stock has to be breaking that support level before this option starts to add intrinsic value, but it's going to be there, and it gives us the precise right to sell the stock at 55. So it's like putting a stop loss on there, because we have that ability to exercise that right if the price of the stock moves to the downside, but it may add value if the price of the stock goes down, right? So we're going to look at buying, first of all, that 55 strike put option. So I'm going to hold my control key down. I'm going to left click on the ask price. There's our order to buy one contract of the 55 put. The expectation here is that this is going to be the offset to that potential downside movement. Not that we're going to necessarily make money on this side of the trade. So that's going to cost us about 55 cents. So now we're going to go to the out of the money call side, and I'm going to look at selling a call for just about the same amount of money. And in this particular case, that's going to put me kind of right here at about the 27 to 20 cent delta, the 61, 62 strike, kind of right in that range. I'm going to go to the chart here and cross-check this, and I'm going to say, where's 62? Well, 62 is right up here about where our flag target was to begin with, right? So we were expecting the price of the stock to kind of move out to that level anyway. So I'm going to go back to the trade tab. I'm going to hold the control key down, and in this particular case, I'm going to sell that 62 strike, and we should get this for about 45 cents. So we're paying about 9 or 10 cents out of pocket, 9 or 10 cents out of pocket to provide protection and the right to sell the stock at 55. And we're bringing in a little bit of premium, and we're setting up the obligation to sell the stock at 62, which is where we were looking at this going to a target anyway. So if it doesn't get there, guess what? Oh, that's okay. If it does, that's okay too, because potentially we were willing to sell the stock at that point anyway. And now if we put this particular trade on, let's do this. I'm going to right click, and I'm going to send this over to the Analyze tab, and we'll take a look at this in the Analyze tab. So here's our long stock position minus the caller, right? So minus the caller, long stock is all the way to zero, but undefined gain to the upside, right? With the caller that we just created for 10 cents, we've now defined our maximum loss here at 55, that 55 strike. So we know what our maximum loss is in the stock, but we've also defined our maximum gain. Here's the thing though, we could always roll this caller out or buy back the call option that we sold and eliminate that obligation and let this continue to run to the upside, right? That's the flexible nature of a caller trade. Oh, and by the way, doesn't that kind of look like a long call vertical? Because essentially that's what it is. That's what this combination is. Long stock, long the put, short the call is a synthetic long call vertical spread, right? Essentially that's what we've created. So we're going to go back to that trade tab, and we're going to fire this order off. And again, this is an illustrative example. I'm going to put this in our protective strategies group, read through this order. And what we don't have is the limitation of the stop, which could kick the trade out, and then the stock could bounce back up. And what we don't have is the vagueness of where is this going to get filled if that stop triggers and kicks in. But what we do have is the cost of this trade, which is $11, which is going up as we speak. So we're going to put that order on, make sure that it's going to the right place, make sure that we're aware of the transaction costs. We're going to fire that order off, and we're going to put that order in. We bought this combo trade for 11 cents, and now we've collared up that GM position, protecting against a potential downside move. Okay. And we've got that scenario in a couple of other places here. One of the other trades that we've got on here is this Coca-Cola trade, right? And we've got a short call. So this has essentially become a covered call on Coca-Cola. Stock, we bought it for 60. It's currently trading at 63. Let's take a look at the chart here for Coca-Cola. And so what's Coca-Cola been doing? It's been moving to the downside. This is a good example, right, of having that collar on and thinking, wow, okay, you know what? I've got that collar on here, but maybe neglecting what's going on with the underlying stock. Because at this particular point, with that underlying stock pushing down into that support level, what we may want to do is kind of roll this protective put position down, eliminate that call option. So let's go back to the trade tab, eliminate that short call option, even though it looks like it's going to expire worthless, right? Let's eliminate that positively so that we avoid any possible pickles here in running into that circumstance. So what we're going to do is we're going to go back to the monitor tab, and I'm going to look at closing that short call that's pretty much done everything that it can do for us. And we're going to click on confirm and send, read through that order. We're going to close this down. Remember, this is an order to close, and we're going to close that down. We might not get filled on that. There might not be a bid on that we could get filled on. But in this particular case, now coming back here and saying, hey, you know what? I've neglected this. I'm going to either do one of two things. I'm either going to sell the underlying stock, or maybe if this is finding a level of support here, I might put a protective put on so that I don't lose anything more in the scenario, or potentially don't lose anything more, because that's never a guarantee, right? So we were finding a level of support maybe right around that 62 mark or so, if we were going to kind of take that as an average right there, okay? Let's go back to our monitor tab, and let's take that Coca-Cola position, cancel, replace. Let's see if we can work this a little bit to try to get that to fill. And I'm going to say, hey, I'm going to open that up a little bit. We'll give it that a little bit more. Just because I want that off, I'm going to go ahead and click on confirm and send. We're going to read through this order. I'm willing to pay up to $7 to close that down. And let's see if we can get that order to fill in this particular case. And we might not, depending on liquidity. And that's one of the things about options that we have to pay attention to, is that option liquidity. So now I've got that level of support here. I might put a protective put on here and then come back and leg into a call option if implied volatility goes up, or if the price of the stock starts to bounce. So in this particular case, I'm just going to put the protective put on as well while we wait for that. So I'm going to protect this out again to about the 13th of December, maybe even the 20th of December. We'll go out and we'll buy that protective put if we can do that. Our support level, we said, was at about 62. So I'm going to buy this protective put at the 60 level, and that's going to kick in and perhaps define our potential loss. That's about where we got into the trade to begin with on the upside. So if I buy that protective put, now that protective put is in position here, and we're going to go ahead and click on confirm and send and put that out. Now, we're buying that. It's relatively small cost. We could sell the call option to bring that back, that down a little bit. But in this particular case, that's a relatively small cost to provide that protection at the 60 put from this going down even more. So we're going to go ahead and click on send and fire that order off. Now we've got that protective put, that filled. That protective put is in place for 40 cents to protect if that stock is going to the downside. Now, is that a guarantee that we're not going to lose any more money? No, but it gives us the precise right to sell the stock at 60 if this does go down. All right. So that's managing a position that we already have. Now, I mentioned at the beginning of the discussion that sometimes we might run into a situation, and I'm going to go back to the monitor tab to display this, and we'll close these working orders. Sometimes we might run into a situation either inadvertently or intentionally we are short stock. So in this particular case, I ended up being, in this particular demonstration account, in this example, short 100 shares of Johnson & Johnson stock, right? And quite frankly, in this example, I don't know if it was intentional or it was inadvertent and I had a short call or part of a spread where I got assigned and I ended up with a short 100 shares of the stock. Regardless, doesn't matter, right? The circumstance is the same. So let's go over here to the chart. So let's go to Johnson & Johnson. Okay, remember, if you short a stock, there are costs associated with shorting the stock. There are risks associated with shorting the stock. Liquidity is an issue. So if that's something that you're going to do, make sure that you understand that strategy. We're not going to delve into shorting stock in this discussion. But here we are now short 100 shares of the stock, and the stock has continued to go to the downside. But what's happening right now is we're seeing a little bit of a bounce. We're getting this little bit of a kind of eensy-beensy, Maxwell's silver hammer candle down here, right? This little tiny hammer candle with that possibility of popping this to the upside. So the risk is that we're short the position, but the price of the stock pops up. And if the price of the stock pops up and we're short the position, we're short the stock, and we're short the stock at about 159. If the price of the stock makes a big move to the upside, for instance, on an earnings announcement or something like that, or news or something like that, then that could get us into that position where we would have to buy it back to avoid, say, for instance, a margin call, or having to buy it back at a significantly higher price than we shorted it at, right? That's the scenario. That's why, say, for instance, a naked call has that kind of theoretically undefined or infinite risk. So what I want to create here is what we call a short caller. So let's kind of walk through this. Remember, a long caller, the one that we just did on GM, is a protective put and a short call option in combination with one another. So a short caller would be then exactly the opposite. So to satisfy the obligation of being short the position, we could create a short put option. That would be the equivalent of the short call in the long caller. And then we could create a long call position, which would be the equivalent of the long protective put in the long caller. Well, I'll show you what it looks like, and you'll see what I mean. Okay, so let's first do this. Let's define a point at which we want to protect this downside position, this short position, meaning at what point do we want to have the right to buy the stock? And that is this. Maybe we find a level of resistance or resistance, as my friend James Boyd says in his fake French accent, because I know he's not French. Not that there's anything wrong with being French, but, James, hey, gotcha. The French accent. Anyway, so we're going to define where our resistance is here, right about what 156, 157 level. We're going to say, look, if the price of the stock starts to move back up above there, I want to have the right to buy the stock at 156 to limit that potential upside risk. So we're going to create a long call position, just like we did with that long put position in the GM example. We're going to create the long call position here as the first step in creating this short caller at that 156-ish strike. So we're going to go to the trade tab for Johnson & Johnson. We're going to go out a little bit in time here. And we're going to look at protecting this out, say, for instance, to the 20th of December. And we're going to look at buying that long call at about that one. So we don't have a lot of granularity there. Let's see if we've got more granularity in the weeklies. We don't there either. So let's go to the 20th of December. And we're going to look at buying, because our resistance level is at 156. So we're going to look at buying the 155, which is kind of the at the money. We might buy the 160, but in this particular case, we're going to buy the 155. Stock's currently trading at 152, so we're limiting the amount that this is going to move to the upside. We're going to buy that 152. It's going to be relatively expensive. Or excuse me, the 155 strike. It's going to be relatively expensive to buy that 155, $1.75. But let's see what this looks like. So let's buy that 155 strike. So I'm going to left click on the ask price. And now we're created that first order to buy the 155 call at $177. That's going to be only part of this trade. Now we're going to come over and we're going to create that out of the money short put. That out of the money short put. So the question is then, where do we put that out of the money short put? So our out of the money short put, if this continues to move to the downside, might be again down here right around that support level, which was previous resistance, right? Down here. And if the price of the stock comes down to that level, that gives us the obligation to buy the shares of the stock, right? To take delivery of the stock. We were short the stock. Those two cancel each other out. It's like having a covered call position. In this case, though, because we're short the stock, we've got to have a short put to create that covered call, that equivalent of that covered call position. So let's do this. Let's go back to the trade tab and let's look at selling the 150 put. Now we're going to sell this 150 put for a little bit more than we paid for the 155 call. So we're actually doing this short caller at a credit. Short caller at a credit. So here's what I'm going to do. I'm going to right click and we're going to go to the Analyze tab and we're going to take a look at this. So here's our short stock position, right? Here's our short stock position. Goes up all the way to 0 if the price of the stock goes down to 0. Goes down all the way to infinity if the price of the stock keeps going up, right? Now if we add this combo, which is the short put and the long call, short put, long call, this is a short combo. We're doing it for a credit. We put that in there and look, we've defined our maximum loss on the trade at 155. We defined our maximum gain on the trade at 150. And oh, by the way, that looks like a long put vertical, doesn't it? A long put vertical. So if our stock plus long caller is the synthetic equivalent of a long vertical spread, long call vertical spread, then our short stock plus the short caller is the synthetic equivalent of a long put vertical spread, long put vertical spread. And we're essentially doing a long put vertical spread for a credit. Wow, that's kind of cool. I kind of like the way that came together. So if you find yourself in that position where you've got an inadvertent, or a trader finds themselves in that position where you've got an inadvertent or an advertent short stock position, one of the ways that that short stock position can be protected using a protective strategy might be to create a short caller spread in this particular case and manage that position. So we're going to go back to the trade tab. We're going to go ahead and we're going to click on confirm and send. We're going to read through this order. And because we're already short the stock, that means that we don't have to hold the cash that we would have to hold otherwise in selling that put option, because it now becomes a short stock covered short put. Does that make sense? Instead of a cash secured short put. And we're going to put it in the protective strategy group. We're going to make sure that we've got any alerts that we need to pay attention to. And we're going to go ahead and fire that order off and close and kind of add that position here. We'll see if that order fills. We might have to work that a little bit. Let's right click, cancel, replace. Let's open up that lock because the market's moved a little bit. We're getting a little bit lower credit here. Now we'll hit confirm and send again, read through that order, kind of work that order again because I was talking for too long, and we'll see if that order fills. And it might not, and it depends on the liquidity of not only the underlying stock, but also on the liquidity of those positions. So we'll look for that to fill here in a minute, but that order is in place. So what we've done, let's just kind of quickly review, come back over here. There it goes. Now that order filled. So we added the long caller position to our General Motors long stock position. We adjusted Coca-Cola by putting in an order to close down that short call option that's done the most of the work that it can do. And then we put in a new protective put. And then we'll come back in at a later date and we'll add another short call there. And then we protected our short Johnson & Johnson 100 shares by putting in a short caller strategy, showing it as the synthetic equivalent of a long put vertical, and looking at kind of both sides of the equation. So once again, my thanks to James Boyd for helping out. Look, if you want more resources about this, come back over here to schwab.com/coaching, and you get the whole webcast list right there, that calendar of going forward. If you go here to the Trader Talks webcast page, which if you haven't clicked on subscribe already, please do so. And then you can type in any of those topics here. Let's say you wanted to compare this to long put verticals. Type in long put verticals, and now you've got those scenarios here in this particular case that you can go back and refer to and watch at your leisure. So once again, hey, the other thing to think about, guys, come and join us at one of these live events. We'd love to have you there. I'd love to say hi to you in person, meet you in person. And if you'll join us there, that'll be great. Also, you can follow us. You can follow myself. You can follow James on X. I'm at Ben Watson CS, and James is at James Boyd CS. Thanks for participating today in this discussion and being here. We'll see you guys again very soon. Thanks to our great production staff. Have a great day. Take care, everybody. Bye-bye.